couple years, in the last decade, has come from emerging market economies. In the United States, our demand for oil, our imports have actually been going down over time. So the demand is coming from a growing economy where we've seen about a 25% increase in emerging market output since before the crisis. And on the supply side, as everybody knows who watches television, we've seen disruptions in the Middle East and North Africa and Libya and in other places that have constrained supply. That supply has not been made up, and that in turn has driven gas prices up quite significantly. So again, this is a very adverse development. It accounts in the short run for the increase in our, pretty much almost all of the increase in our inflation forecast, at least in the very near term. There's not much the Federal Reserve can do about gas prices per se, at least not without derailing growth entirely, which is certainly not the right way to go. After all, the Fed can't create more oil. We don't control the growth rates of emerging market economies. What we can do is basically try to keep higher gas prices from passing into other prices and wages throughout the economy and creating a broader inflation, which will be much more difficult to extinguish. Again, our view is that most likely, of course we don't know for sure, but we'll be watching carefully, our view is that gas prices will not continue to rise at the recent pace, and as they stabilize or even come down, if situation stabilizes in the Middle East, that will provide some relief on the inflation front, but we'll have to watch it very carefully.
Thank you. Scott Landman from Bloomberg News. Mr. Chairman, you've stated several times this year that the recovery won't be fully established until we see a sustained period of stronger job creation. First, has it become truly established yet? And if not, what's your definition of a sustained period? What's your definition of stronger job creation?
Well, as I mentioned, we've made a lot of progress. Last August, when we began to talk about another round of securities purchases, growth was very moderate, and we were actually quite concerned that growth was not sufficient to continue to bring the unemployment rate down. Since then, we have seen a reasonable amount of payroll creation, job creation, and that picked up in the most recent few months, together with a decline in the unemployment rate from 10% down to the current rate of 8.8%. So the labor market is improving gradually, as we say in our statement, and we just like to make sure that that is sustainable, and the longer it goes on, the more confident we are. And again, it is encouraging to see the improvement we've seen in recent months. That being said, the pace of improvement is still quite slow, and we are digging ourselves out of a very, very deep hole. We are still something like 7 million plus jobs below where we were before the crisis, and so clearly the fact that we're moving in the right direction, even though that's encouraging, doesn't mean that the labor market is in good shape. Obviously it's not, and we're going to have to continue to watch and hope that we will get stronger and increasingly strong job creation going forward.
Robin Harding from the Financial Times. Mr. Chairman, you say in your statement that longer-term inflation expectations have remained stable, but a number of measures of inflation expectations have risen in recent months, and it's clear from your forecast that you expect headline inflation to run above core inflation for some period. Is there anything that the Federal Reserve can do to prevent the public from maybe incorrectly assuming that a period of higher inflation is on its way as a result? Thank you.
Well, again, the inflation expectations that we are concerned about are medium-term inflation expectations. So we have seen, for example, in financial markets, in the indexed bond market, for example, or in surveys like the Michigan survey, we've seen near-term inflation expectations rise fairly significantly, which is reasonable given higher commodity prices, higher gas prices. But for the most part, although there's been some movement here and there, for the most part, I think it's fair to say that medium-term inflation expectations have not really moved very much, and they still indicate confidence that the Fed will ensure that inflation in the medium term will be close to what I've called the mandate consistent level. What can we do? In the short run, we can communicate and try to make sure the public understands what our policy is attempting to do. to be clear what our objectives are and what steps we're willing to take to meet those objectives. Ultimately, if inflation persists or if inflation expectations begin to move, then there's no substitute for action. We would have to respond. I think while it is very, very important for us to try to help the economy create jobs and to support the recovery, I think every central banker understands that keeping inflation low and stable is absolutely essential to a successful economy, and we will do what's necessary to ensure that that happens.
Mr. Chairman, what will be the impact on the economic recovery, job creation, and rates on mortgages and other loans when the Fed ends its $600 billion bond buying program? And a quick follow-up is, will the Fed how long will the Fed continue to allow for reinvestments? Thank you.
As I've noted, and as you're all aware, we are going to complete the program at the end of the second quarter, $600 billion. We are going to do that pretty much without tapering. We're just going to let the purchases end. Our view is that, based on past experience and based on our analysis, is that the end of the program is unlikely to have significant effects on financial markets or on the economy. The reason being that, first, just a simple point that we hope that we have telegraphed today, we hope we have communicated what we're planning to do, and the markets have well anticipated this step. And you would expect that policy steps which are well anticipated by the market would have relatively small effects, because whatever effects they're going to have would have already been capitalized in the financial markets. Secondly, we subscribe generally to what we call here the stock view of the effects of securities purchases, which by which I mean that what matters primarily for interest rates, stock prices, and so on is not the pace of ongoing purchase, but rather the size of the portfolio that the Federal Reserve holds. And so when we complete the program, as you noted, we are going to continue to reinvest maturing securities, both Treasuries and MBS, and so the amount of securities that we hold will remain approximately constant. Therefore, we shouldn't expect any major effect of that. Put another way, the amount of ease, monetary policy easing, should essentially remain constant going forward from June. At some point, presumably early in our exit process, we will, I suspect, based on conversations we've been having around the FOMC table, it's very likely that an early step would be to stop reinvesting all or part of the securities which are maturing. But take note that that step, although does constitute a policy tightening, because it would be lowering the size of our balance sheet and therefore would be expected to essentially tighten financial conditions. That being said, we therefore have to make that decision based on the outlook, based on our view of how sustainable the recovery is and what the condition the situation is with respect to inflation. So we will base that decision on the evolving outlook. It depends on the outlook. The committee will have to make a judgment.
Is it in the Fed's power to reduce the rate of unemployment more quickly? How would you do that, and why are you not doing it?
Well, I should say, first of all, that in terms of trying to help this economy stabilize and then recover, the Federal Reserve has undertaken extraordinary measures. Those include, obviously, all the steps we took to stabilize the financial system during the crisis, again, many of which were extraordinary measures taken under extreme circumstances. Even beyond the steps we took to stabilize the system, we have created new ways to ease monetary policy. We've brought the federal funds rate target close to zero. We have used forward guidance in our language to affect expectations of policy changes. And of course, as everyone knows, we have now been through 2 rounds of purchases of longer-term securities, which have seemed to have been effective in easing financial conditions and therefore providing support for recovery and for employment. Going forward, we'll have to continue to make judgments about whether additional steps are warranted, but as we do so, we have to keep in mind that we do have a dual mandate, that we do have to worry about both the rate of growth but also the inflation rate. And as I was indicating earlier, I think that even purely from an employment perspective, that if inflation were to become unmoored, if inflation expectations were to rise significantly, that the cost of that in terms of employment loss in the future, as we had to respond to that, would be quite significant. And so we do have to make sure that we are paying adequate attention to both sides of our mandate, but clearly it is the case that we have done extraordinary things in order to try to help this economy recover.
John Itzty with NPR News. Mr. Chairman, it's the view of a lot of economists that the second round of quantitative easing hasn't done much to help the economy. What positive effects can you point to directly? And if there are positive effects, can you really afford to end the program in June with the unemployment rate still around 9%?
Thank you. Well, first, I do believe that the second round of securities purchases was effective. We saw that first in the financial markets. The way monetary policy always works is by easing financial conditions, and we saw increases in stock prices. We saw reduced spreads in credit markets. We saw reduced volatility. We saw all the changes in financial markets, and quite significant changes, that one would expect if one was doing an ordinary easing of policy via a reduced federal funds rate. And indeed, we saw the same types of financial market responses in the first round, which began in March of 2009. So we were able to get the financial easing that we were trying to get. We did get very significant easing from this program. You would expect, based on decades of experience, that easing financial conditions would lead to better economic conditions. And I think the evidence is consistent with that as well. As I discussed in more detail in my Humphrey Hawkins testimony in the beginning of March, between late August, when I first indicated that the Federal Reserve was seriously considering this additional step, and early this year, not only the Federal Reserve, but many outside forecasters upgraded their forecasts, and we saw strengthening labor market conditions, higher rates of payroll, job creation, etc. Now, the conclusion, therefore, that the second round of securities purchases was ineffective could only be validated if one thought that this step was a panacea, that it was going to solve all the problems and return us to full employment overnight. We were very clear from the beginning that while we thought this was an important step and that it was at an important time when we were all worried about a double dip and we were worried about deflation, we were very clear that this was not going to be a panacea, that it was only going to turn the economy in the right direction. And indeed, we published some analytics which gave job creation numbers which were significant, but not certainly not enough to completely solve the enormous jobs problem that we have. So again, relative to what we expected and anticipated, I think the program was successful. Why not do more? Again, this was similar to the question I received earlier. The trade-offs are getting less attractive at this point. Inflation has gotten higher. Inflation expectations are a bit higher. It's not clear that we can get substantial improvements in payrolls without some additional inflation risk. And in my view, if we're going to have success in creating a long-run, sustainable recovery with lots of job growth, we've got to keep inflation under control. So we've got to look at both of those, both parts of the mandate as